Hello and welcome to our webinar this evening. I'm Rich Harvey, CEO of Property Buyer, and with me in the studio today is Peter Faludi. Welcome, Peter.
Thank you very much.
Tonight, we're going to be talking about finance for commercial buyers and developers. One of the key issues faced by buyers, including commercial investors and property developers, is getting finance in the current market. So that's one of the things we're going to be covering tonight. For most buyers, the need to get finance in the transaction is fundamental to complete their projects. There's a range of financing options available, and that's increased over the last 2 years. But knowing who to talk to and the nature of such banking finance is often unknown. Most buyers know who the banks are, but there's a lack of knowledge around who the non-bank lenders are. For those who are using a finance broker to get them assisting in the finance, the recent Hayne Royal Commission has highlighted the possibility that many brokers may not be acting in a truly independent way. And that results in conflicts when recommending the best financier to use and which borrower they should go for. In such a difficult environment, we thought it'd be appropriate to have an expert in Peter Faludi come along today who specialises in this area. He focuses on the commercial and the legal aspects of finance, and he's going to discuss some of the traps that you need to be aware of. So I'd really like to invite Peter to speak with us today. Just to give you a little bit of background on Peter, Peter is the founder and director of Peter Faludi Consulting. He's got a long-standing and distinguished career spanning over 30 years as a trusted advisor to many commercial property investors and property developers. He's also been a partner and senior counsel to a number of highly regarded law firms, including Blake Dawson Waldron and also Ernst & Young and DLA Piper. And Peter has negotiated hundreds of deals before, and he makes sure his clients are protected all the way through the process. Now, Peter has a very high attention to detail, and he's developed a very deep understanding of the clauses found, particularly in the fine print of documents, which can often be overlooked by borrowers and investors. And that can have a truly devastating effect on them. So without further ado, I'd like to invite Peter to share your knowledge. So welcome, Peter.
Thank you, Rich. I appreciate the opportunity of getting involved in this webinar. But before we get on to the main topic, I just thought it'd be great if you could let me know a bit more about your business and what you do and your background.
Sure. So I've been running Property Buyer for 18 years this year. We're Australia's most awarded buyers agents with 33 awards for excellence. We've almost done over 3,000 property transactions for our clients over those years. We look after home buyers, investors, commercial buyers and developers. We're currently retained by around 70 developers from the very big end of town right through to the very boutique developers. So we look after quite a wide range of developers, and we help them to identify properties. We do feasibilities for our clients and refer them on to other experts like yourself to really put the whole package together. So really, as a buyer's agent, we work as an end-to-end solution through the whole process to help them with everything we do.
Fantastic.
Yeah. So Peter, given the nature of the current market, what are the trends and other things that you're seeing out there, and what's changed this year? And do you think the market is changing at the moment?
Well, I think in terms of the actual market, it's probably something that maybe you could give some more insight on, and I can talk about the non-bank lending.
Sure. Okay. No problem. Yeah. Okay. Well, look, I'll just give a quick market update on a couple of things. So today we're going to be covering a quick market update. We're going to be looking at some of the non-bank lenders in the market, some of the pros and cons of those banks, and then we're going to talk about some of the strategies with those lenders as well, and also talk about off-market development sites and how you can make them best of the current market. So, Peter, your question about where are we at in the current market? So, yeah, I get asked this question every day of the week. So. A couple of things that we can look at here. Number one, we're seeing that there's been a dramatic decline in the volume of transactions. So nationally, we're down around 16.5%. But look at Sydney and Melbourne on the bottom of this chart. Melbourne's down 25% and Sydney's down 18% in the volume of actual settled sales. There's another chart coming up at the end which actually shows the volume of listings, which is significantly reduced. But that's quite significant. So that's in terms of where the volume of sales is. In terms of auction clearance rates, well, auction clearance rates have rebounded incredibly strongly. Since the election, we've seen a dramatic turnaround in property confidence, and buyers are just coming out of the woodwork. So auction clearance rates have been between 70 to 80%. I think last weekend in Sydney it was 82%. This is last week in India. Sorry, 83.9% we're saying here. Sorry. But an incredible in the city, 83%. Northern Beaches, 72%. Upper North Shore, 93%. So very, very strong rebound in the property market as a leading indicator. But we also have turned the corner, Peter, where you can see on this chart, which just shows the change in dwelling prices for each of the capital cities, the main ones. You can see here that Sydney, Melbourne, and also Perth is just starting to turn. But particularly Sydney, Melbourne has really rebounded. I think we had a peak to trough decline of around anywhere from 15 to 20%, but now we're back up 5% and rapidly rising. So the market is definitely well beyond the bottom, and we are definitely coming on the way back up. Canberra's been quite a strong market. Its price growth, I think, will level, and Darwin's actually starting to show a bit of surprise as well. So that's a quick whip around the cities. And in terms of, I mentioned about the volume of property listings. In the last 12 months, the volume of new listings is down 31%, and over 12 months, the actual total volume of all listings is down 15%. So that shortage of stock coming out of that winter period is leading to quite a dramatic price spike in the current market at the moment. So that's what we're seeing. A lot of frustrated buyers out there that just can't find what they're looking for.
And do you think that's going to continue?
That's always the million-dollar question. Look, I think as we go through spring, the agents are saying that they're not listing a huge volume of properties at the moment, but I think we'll probably have a late rush in spring. And, I think the price growth, the price spike will kind of moderate a bit, but I do think we're going to continue to climb. I mean, yesterday I spoke to the economist at UBS, and they've revised their forecast. They're saying a 5 to 10% growth in the property market in Sydney for the next 12 months. So same with the Maverick economist, Christopher Joy, same thing. He's saying there's going to be double-digit next year as well. So hopefully APRA won't put cold water on everything again. But
do they distinguish between like existing properties as opposed to like off the plan, or is it all
it's all together. No, they don't. That's the start. The data unfortunately doesn't distinguish that way. So yeah. So Peter, I'd just like to sort of move on to sort of your area of expertise, if we could. So you mentioned in your introduction that you've got a lot of dealings with non-bank lenders.
Yeah.
And in the Australian market, can you just perhaps outline to our viewers here what to look for when dealing with non-bank lenders?
Well, as we all know, the banks really pull back on property finance, and particularly for developers. And as a result, in order for developers to actually get finance, they've had to look at alternative sources of finance. And given the low yields available on other investments, a lot of people have seen the opportunity to come in and start lending on property. And they're not banks, they can be private, high net worth people, they can be international fund managers, they can be institutions from overseas, they can be private equity. So they will come in and they are offering products to developers and commercial investors. And there are a few that also offer it for mums and dads. But today's discussion will be in terms of how the finance they offer to developers and commercial property investors.
Okay. So have the banks just really tightened up considerably? Like what's some example? What sort of things have they tightened up on? The volume of pre-sales or the amount they'll lend? Or
well, to be honest, my understanding is that, unless the deal ticks all the boxes, they're not prepared to bank it. They're slow in actually getting approval and, getting to the point where they're ready to move forward. And so it's frustrated people that have good deals but don't tick all the boxes. They won't get the money from the bank. Or they're the borrowers are frustrated because they've got to wait for months and months and months to actually get the loan. So for these reasons, the non-bank lenders have come in because they don't have those same negatives.
Yeah, and they're here to stay, right? They're grabbing more of a market share from the banks.
Oh yeah, I mean in the UK apparently the percentage of the total commercial property finance market that's from non-bank lenders is about 30 to 40%. Whereas in Australia, I understand that it's more like 20%. So there's a lot of opportunity for non-bank lenders to grow. And given that there's a view that interest rates are going to remain low for some time, when you can get quite high returns on fairly safe investments like a property loan, first mortgage, I think, yes, they're here to stay.
Okay. Well, Peter, perhaps you can just tell us, in your view, what are the main benefits or the pros and cons, I guess, of dealing with non-bank lenders? So perhaps the sort of the advantages or disadvantages in dealing with non-banks versus the banks.
Well, as a general statement, non-bank lenders are more commercial when they deal with a borrower. They're prepared to bank deals that don't tick all the boxes. They're prepared to lend into they understand the commercial benefits of a property deal. So, bankers sometimes don't really understand the nuances of a property deal. They've just got their checklist and they have to tick it off. But if you actually have a property person look at a deal, they will have a better understanding of why it's a good deal. And so they're more likely to lend to a deal which a bank might not. They do say that they provide a much quicker turnaround compared to a bank. And, I've seen that myself on transactions that I've been involved with where they've been very quick. They're more willing to negotiate terms because they are more commercial and reasonable. They don't have to rely on standard terms. I mean, obviously all lenders like to have their standard terms, but I think banks often hesitate to make any changes to those. And for them to have longevity in this market, they do have to establish a relationship with the borrowers, because one day the banks will come back into the market. And at that point, the question will be, well, why should this borrower not then go back to the bank? But if the borrower has had a good experience with a non-bank lender, then there's more chance. So they're conscious of developing a relationship, which even though I understand banks do, I think they're probably not as focused on it as the non-bank.
Yeah, great. Okay. Well, that sounds like there's a lot of positives to working with a non-bank lender. I guess on the flip side, what are some of the disadvantages for borrowers in dealing with the non-banks?
Well, the main disadvantage is pricing. Their interest rates are higher than a bank because, they often can't get, well, I suppose the thing with non-bank lenders is that there's such a diversity of where the funds are coming from that the interest rates do vary. So even though they're generally higher than a bank, when the money is coming, say, from a Japanese institution or an American institution like an insurance company, they can offer lower rates than, say, a private equity funded non-bank lender where they have much higher hurdle rates. So pricing is the main concern, but I think the pricing is improving because there are so many non-bank lenders and the amount of deals on the market is less. There's a lot more competition for them to provide more competitive pricing. And I have met people who have got non-bank lending money and they are offering it at very, very reasonable rates. And so once somebody gets over that obstacle of the pricing, what's
the differential in pricing? Can you unpack that a little bit for me? How many basis points are we talking?
Well, obviously, I think most non-bank lenders tend to go for a fixed rate as opposed to a margin over bank bill rate. And their rates tend to be, if it's a construction loan, it's generally has in the past been between 11 and 15%, which is quite high. And I have had developers say to me that, once you go over 10%, they're not interested. But I have heard of loans for less than that. And I think, as I mentioned just before, given the competition, their rates will come down. For commercial lending, where somebody wants to borrow money for, say, buying an office building or something, they're lower rates because there's less risk from the non-bank lender's perspective. And the thing that non-bank lenders can provide is that some of them can provide up to 10 years fixed rate funding at current interest rates, which for a buyer or a borrower is very attractive if you've got a income-producing asset. The lock-in rates now for 10 years, the banks can't offer that.
Yeah, that's right.
But that's in terms of negative pricing. Sometimes their documents contain terms that you don't find in a bank's documents. For example, most non-bank lenders, because depending again where the money is coming from, but if you've got high net worth individuals who are giving an investment manager their money to put out, they don't want to put it out and then just have it repaid in 3 months when they've anticipated it's going to be there for 2 years. So depending on who your non-bank lender is, there is often a minimum interest requirement. So even if somebody was to find a cheaper lender and want to refinance the non-bank lender, they still have to pay interest for a minimum period, which can be from 6 months to 12 months, depends on the non-bank lender. So that's something you don't see in a bank document. So that's, I suppose, a bit of a negative. Because there is such a wide range of non-bank lenders, some of them can be quite aggressive if there's a default, and they may pull the pin, whereas the bank might work through it. And some of them have got terms in them. For example, I've seen non-bank lenders where if there's a default, they have an option to buy the property or an option to buy the borrower. Banks don't have that. And, you know, borrowers might not be happy. And then the last thing is that, you know, everybody knows who the banks are and they don't need to worry that there's money coming when they need it. With non-bank lenders, you know, I have heard of situations, particularly in construction lending, where, you know, a progress claim is made by the builder and the lender doesn't actually have the money to provide it. So particularly in construction lending where there's ongoing drawdowns, there is a risk, depending on who the non-bank lender is, that they won't have the money. So one thing that borrowers who deal with non-bank lenders need to do, which they don't have to do with a bank, is they actually have to do due diligence on their lender. They have to sort of ask them questions and find out, you know, whether they're going to be good for the money and good to deal with.
Well, you're saying it works both ways. Don't just trust the lender to have the money. If they're non-bank, make sure that they're bona fide.
That's right.
So another question for you, Peter, given the diversity of the non-banks that are out there, what are some of the strategies and things that borrowers should look out for when they're actually dealing with these types of lenders?
Well, I think it's all come back to the due diligence that they have to do. So I think you need to find out where the money is coming from. If it's coming from offshore, then depending on where that is, there may be difficulties in the money actually hitting Australia when you need it as a borrower. And it's also important to know who's providing the money, if it's high net worth individuals, local or offshore, or, you know, an institution, because, you know, if it's a foreign institution, they have a reputation, and if they get known in the market as not having the money, they won't want that. So, you know, I think reputation is very important. Their track record in Australia is something you should look at. If this is their first deal, then, you know, you have really no ability to assess whether they're good for the money or good to deal with, because they've never dealt with it, this market before. Also, who's behind the non-bank lender? A lot of non-bank lenders, especially offshore ones, they engage an investment manager in Australia. They give them a mandate, say, we want you to lend X millions of dollars. So, you know, the person who's actually looking after it is a local. But if the people that you're dealing with on behalf of a non-bank don't have any experience in the market, or they're not ex-bankers, which a lot of non-bank lenders are, you know, the people that work are ex-bankers, then you need to wonder whether they're actually going to be, you know, good to deal with. And where are the decisions made? Because again, if you've got, even if you've got an investment manager here, they won't necessarily have the right to make the decision. You might have to go back to a foreign country to make the decision. So that can affect the timing and the certainty of, you know, how it's going to go down the track.
Okay. Some great thoughts there. One thing we mentioned in my introduction, Peter, was around the issue faced by borrowers that their finance broker may not be acting in their best interests, or they might be conflicted when they're making a loan and who they should go with. I'd be interested to hear your views on this, because this was something that certainly came out of the Royal Commission around conflicted commission. So what's your views on how to sort of work with a broker that does have the borrower's best interests at heart?
Well, I think, you know, when you're considering a loan that's been put to you by a broker, you need to not only know what the interest rates are and the fees, but you actually need to have an understanding of some of the, you know, non-financial or fine print, as I call it, terms that will be in the loan documents. And, you know, brokers aren't lawyers, so they're not really going to put that forward. But I think to demonstrate that they are actually acting in the best interests of a borrower, they should suggest to the borrower that they get some advice before they actually sign a term sheet on these non-financial terms, because I've seen it where people just sign term sheets because they're happy with the interest rate and the loan amount and the term of the loan and the fees, but then they don't read some of the clauses that are categorized as fine print. And then when they actually understand what that clause is, they say, oh, no, we can't proceed. And you often cannot renegotiate those things. So from my point of view, if a broker offers a suite of loans and recommends them, then I think to really demonstrate to their client and also to any regulator that wants to question their independence, well, how does the borrower know that they're acting in the best interest? And then if somebody has given advice on this other piece, then clearly they're just trying to show the whole picture to the borrower. So it's easy to demonstrate that you're actually acting in the best interest. I don't know if we have time, but I have some examples of actual transactions. So I was involved in a matter where an offshore fund manager bought a office building in the city of Sydney, and they used equity. They didn't use any debt. Once they finished once the transaction completed, they wanted to repatriate some of their money back to offshore. So they got a term sheet without coming to us first. They got a term sheet from a bank, and the term sheet said the borrower cannot borrow money from anybody else or buy another property without this bank's consent. And that's a normal thing because the bank wants to quarantine the risk around its borrower. So you can imagine if that borrower can borrow money from other banks, buy other properties, it could become insolvent because of that other deal. Anyway, they signed the term sheet with this in it, and then we started getting the full loan documents, and that one-liner became a whole paragraph. And then once they read that paragraph, they understood what they'd signed. They said, oh no, we can't have that. And unfortunately, despite trying to renegotiate it with the lender just said, no, that's how we got credit approval, that's how we have to proceed. And this was a $40 million loan, which then fell over. That one thing in the term sheet, which was not acceptable, was not known, caused the whole loan to fall over. So that was quite a major point. And then maybe just another one, which is quite common, is the issue of pre-sales. So obviously with construction lending, lenders require a certain amount of pre-sale cover. And what happens is that the developer is very keen to sign up purchasers. And so even though they have a pro forma contract, some purchasers will want to amend the contract. And because the developer is so keen to get the pre-sales, he will agree to amendments. If that developer's lawyer doesn't realise what the financier's criteria is for a qualifying or compliant pre-sale contract, a lot of those changes could have the effect of making those pre-sales not count for the financier. And I've been involved in matters where every pre-sale was knocked back by the lender because the developer and its lawyer just agreed to things which were unacceptable. So it's sort of a conflict from the developer's point of view, is they want as many pre-sales as they can get, but it's not a matter of the number, it's also the quality of the pre-sale, and borrower needs to understand what the lender's criteria is. And then maybe just one more, which is to do with the structuring. So often with a loan, you know, the vehicle buying the loan is structured in a particular way and the loan structured in a particular way. But we had one matter where a lot of arm's length self-managed super funds were investing in a trust, and that trust was then going to borrow money for a development. But the lender's term sheet said that the investors in the trust had to give a security interest over their units in the trust. But self-managed super funds can't grant security as a matter of law. So even though the term sheet had been signed, which had in it this requirement, when we realised that all the investors were self-managed super funds, we went back to the lender and said, I'm sorry, but you know, we can't provide that. Luckily, the lender was understanding and went ahead with that deal, but that structure had the consequence of potentially losing that deal because it wasn't factored into it. So these are real life examples where not knowing the term sheet or the other issues associated with the loan really can have very negative consequences.
Oh, thanks for those examples, Peter. I mean, it's like, I think the devil is in the detail. I mean, the key message here is don't just presume that because you've signed a term sheet, it's all going to fly. I think it's very important to actually have the terms negotiated up front in that term sheet before you commit to any kind of lending, and get advice on the particular clauses that are going to go into the borrowing document. So it's very important, Peter. Yeah. So I think let's move on now to the next section, Peter.
So I was interested to know, Rich, how you find development sites for people, because I know from my own experience that a lot of investors, particularly some offshore ones, they only want to buy off the market properties.
Yeah.
And so the secret is obviously to find those properties. So how do you actually find these sites, and what sort of properties do you get?
Yeah, well, great question. I get asked this all the time, how to find off-market development sites, and that's what I specialise in. I've got a special division within my team of property buyer that helps our developers to find off-market. So off-market means it's not advertised to the general public. It might be that we find a site directly with an owner, and we do a feasibility and present that. So I mean, some of the things that we've had experience. Well, I guess I've got this slide up here because I just want to get a bit of encouragement to our fellow developers out there. It's a tough game, and we know how hard it is to find development sites. So if I can offer any kind of encouragement to both developers and investors out there, is never give up. I love the expression.
Well, he's starting very young.
Yeah, he's starting young, this one. But I love this. It's like, I'm determined, and you get so many knockbacks in this game. There's so many sites you have to look at. We call it like kissing a lot of frogs before you find the prince.
Sure.
So, and that's what you do. It is a numbers game about going through and finding the right one. But to answer your question, the types of sites that we look for our clients is very, very wide and varied. So we've found large land subdivision sites, particularly large tracts of land out around towards Badgerys Creek and the northwest and the southwest and western parts of Sydney, and also the Hunter Valley. We've sourced many multi-unit residential sites for our clients, student accommodation, hotels and motels, seniors living sites and retirement villages. In fact, I've acted for some of the larger groups where they're amalgamating or trying to expand their existing facilities, and we're buying the adjoining sites to their retirement villages. And it takes a long time to build rapport with those owners. I had to buy a number of properties in the Waverley area for our clients, and it took about 3 years to acquire 8 of the sites over that period of time. So there's lots of cups of tea and lots of door knocking to actually find those kind of sites. So we had to be very, very persistent to find them. Townhouse sites, mixed-use sites, waterfront sites, subdivisions, and then just boutique sites. So, but as I said, we do a wide range of those kind of sites. I guess, look, it's not like there's a one-size-fits-all. When we find a site, we do a feasibility on that site to make sure it stacks up and meets the minimum hurdle rates that's required. And that's quite challenging too, because every developer has different building costs and they have different consulting costs. So ours is a draft feasibility, and then we work with our developer to refine that to make sure it really stacks up.
Right. Okay. So what are some of the classic mistakes you've seen developers make when they're buying a property?
Oh, I guess some of the mistakes they make is not analysing the resale values. So one of the key variables into working out if a site's profitable or not is to work out what's your resale rate, so your price per GFA, gross floor area. And I see some developers overstate that, and they'll get themselves in trouble, or other developers understate that and miss out on a really good opportunity in a rising market. Another one is that they might obviously want to do a put and call and get a delayed settlement for the property, but a lot of owners just want a straight sale. They don't understand put and call, and I have to sit down and explain how it works and say it's a guaranteed sale, it's locked in. But I see some developers, if they could just be a little bit more flexible or work out some kind of financing arrangement to try and get, a 12 or 18 month settlement instead of a 24 month settlement, I could reckon a lot more deals would potentially go through. Right. So I think that's one. So accurate feasibility is definitely a key. Not allowing enough for contingency costs. So a lot of developers might only put 2% instead of a 5 or 10% contingency rate in their feasibility, and that's really important. And obviously the biggest one is time delays. Dealing with councils, we all know is a nightmare. The amalgamations we've had across New South Wales, with and a lot of planning departments are still in a state of disarray. So when a development is knocked back and there's time delays and you're paying out a big interest costs, that can really kill the profitability of a development. The other one is market changes, just seeing the market turn and change. And, we've been very fortunate in this year, in 2019, to see the market turn around quite rapidly after the election, and we're starting to see values rise. Another mistake I've seen developers make is poor design, is they'll design the wrong kind of property for the local market.
Right.
And the way to understand the local market is, if you live there, fantastic, but it's not just a matter of living there, it's visiting other developers or developments in the area, talking to local agents, and particularly the downsizer market, which is a very, very strong market at the moment. There's good opportunities to build medium density, low maintenance, high quality properties for downsizers. They're cashed up, they want to sell their big family homes, they want to move out, and they want high quality properties that are low maintenance. So generally large 3-bedders, units or townhouses close to amenities is absolutely key. So they sell out very quickly if they're designed right and not too small and pokey and have got the right finishes. But it's not just about the finish. It's about the design and the style that goes with it that's really important.
Well, I think actually that's a good point, because with all the problems with Opal Tower, Mascot Tower, I mean, it's been written in the press that there seems to be a preference away from high-rise.
That's right.
And from a financier's point of view, given those examples, I think they would probably prefer to bank a medium density.
Yeah. And there's new legislation coming through, they call it the missing middle, and that's coming through. So I think one of the things, just to mention too, if anyone watching this is interested to work with us as a developer or commercial buyer, we have a very, very detailed agent database. So we have over 3,500 on our database, and we send out buyer requests to our database to find opportunities, to get the first look at many opportunities. We also letterbox drop and door knock to find opportunities direct to vendors. And we also make sure we do the feasibilities thoroughly. We're not wasting your time or our time in selling sites that don't stack up. And we obviously are buyers agents, so we don't let the spin, as you call it, of the agents influence the decision. And we just charge a very simple fee of 2% as a sourcing fee to find that property. And with our developers, we work on an open agency basis, so there's no exclusivity required. It's just, if you want to work with us, we find a site, then that becomes applicable. So we've had some great success, and in fact, I think I've got a slide here. Yeah. So this is just a quick snapshot. The last 18 months, 24 months that we've found a number of these kind of sites right across, particularly the Sydney region. So some from renovator sites, boarding house sites, duplex sites, hotel sites. We're actually looking at a couple of childcare sites at the moment as well, and also some very large unit amalgamations that we did one in the Lower North Shore, where we amalgamated 3 unit blocks together, and that was like herding cats, Peter. That was incredibly difficult to get there, to get unit owners to agree 100% rather than go through strata reform, but we eventually got this. So we've got a track record of being very successful in that space, and we've got a number of opportunities we're about to close before the end of this year as well.
Okay, that's great.
So Peter, back to you again. So given your experience on the financing side of things, perhaps you could just give us a couple of, I guess maybe your top 10 tips, if you like, on what people can do to improve their ability to get finance and when looking at finance documents.
Well,
we'll go to the first one.
The first one is to, as I've touched on with that example, you're going to make sure the project's ownership structure is consistent with the financier's requirements. The financiers have security that they want, and you need to be able to obviously meet that requirement. If you can't, then you really need to know that before you sign the term sheet and negotiate with the lender to either make their financing requirement consistent with your structure, or alternatively your structure consistent with their requirements. So I think that's important, because you can spend a lot of money setting up the structure before you start thinking about financing, and only to find out that it's not going to work. So that's money and time wasted. So that's the first one.
Yep, the next one. Sure. Yep.
The next one, as we've talked about as well, is to do due diligence on your non-bank lenders. It's a real spectrum. So you've got, as you can imagine, in a market which is offering top returns, fairly safe, everybody's going into it. And so you've got people that I suppose are on the fringe, and then you've got all the way up to institutional and everything in between. So just because one, you may have had a good experience or heard about some client that had a non-bank lender that was a good experience, that doesn't mean that the other one necessarily going to be the same. So you do need to do that. That's very important.
Okay, number 3.
Well, again, Opal Tower, Mascot Tower, I think has highlighted that you really need to have, you know, good consultants, good builders involved in a project. And from a financier's point of view, the more high quality, reputable consultants and builders you've got involved in the project, the more bankable the deal will be.
And just on that one, Peter, again, we can recommend some really high quality builders to our clients as well. We have great relationships with them, and we also have an opportunity to help those builders even save more costs through a procurement service that we're involved in as well, direct to China. So a lot of our builders are taking advantage of that and saving up to 40 or 50% on Australian building costs. But it's also about using, as you say, high quality builders that have got a reputation, because that will really make
and then this is a particularly important thing for first time or foreign developers, because, you know, a foreign developer may have a great track record in their home country, but then they come here and they've got no track record and they really don't know much about the market, which is where, you know, again, your knowledge would be invaluable. So by a foreigner or inexperienced person having a group of consultants, builders who have got the track record, the lender will be of the view, well, it doesn't really matter that this person doesn't have the experience, because everybody who's actually running this project does, so therefore it's more bankable. That's
it, yeah. So what's your 4th tip?
Well, obviously you've got to appear to any financier that you're really across your project. And I think it does create the perception with a financier of your level of competence and professionalism. If you have got, you know, detailed feasibilities, you can provide the information quickly. When they ask you a question, you can answer it on a timely basis. That demonstrates that you actually know what you're doing. So I think, you know, to think that you can approach a financier who's got very high level, you know, information and you can't answer all their questions, that creates a very bad, you know, smell with the lender.
That's it. Yeah, exactly. All right, number 5.
Number 5 is, this is one of these hidden clauses which most people, you know, unless they get advice, don't know. And that is that financiers normally have a right to review their terms. So even though you have a term sheet which sets out the terms and you're happy with those terms, often you will find when you get the more detailed documents that the lender can actually change those terms. Either, you know.
So what you're telling me, if I've signed a loan agreement with a funder, and I said, look, my interest rate's, you know, 8.9%, right? Can they go and change that to 10% overnight?
No, they can't do that, but they could. There are standard terms even in bank documents which are, you know, where there's, say, some market issue.
Right.
And this was caused by the GFC, and these clauses went into it then, where, you know, the cost of funding for that lender goes up dramatically due to market circumstance, not something personal. They have that right. But in addition to that, they often have the right to just every 6 months have a review, and then following that review, change the terms. And, you know, as a borrower, you don't want them to do that, obviously, but if they have that right, it should be qualified. So they can only change terms where their review indicates that something negative has happened vis-a-vis the borrower or the project, and that requires them to change the terms.
That makes sense, okay.
And this just on this point, this particularly comes up where you get a term sheet which it happens with banks as well as non-banks. The term sheet will say, the terms and conditions in standard term conditions booklet number 64 are also included in the loan. They're meant to provide a copy of that book, and they often don't. And so people will just sign it. And then when you get that book and you turn to page 22, it'll have a really wide review right. So, you know, it is important that somebody knows what's in these other documents that are coming down the track, and you know it before you sign rather than later, because when it's later, it's too late.
Good tips there. Okay, so number 6.
I suppose along the same lines, negotiate changes before credit approval. So the normal spectrum is you'll get an indicative term sheet, which is very high level, doesn't have a lot of detail. Then you, as a borrower, if you're happy with the sort of main terms, you'll sign it. Then that will go to the credit committee of the lender, who will then approve the loan, and then you'll get a more meaty term sheet which you need to sign. But once it's gone and got credit approval, if you then subsequently find out there's something that you don't like, it's very hard to get that change, because the lender will normally say, I've got to go back to credit, and that could take a few weeks, and I've got to go back to internal legal. This is a bank that would say that. And most borrowers will say, oh, look, I haven't got the time, so I just accept it. That's why I say, if you don't do it up front, then, you could put yourself in a take it or leave it position.
Gotcha. Yep, makes sense. Okay. Lucky 7.
Oh, the pre-sale trap is what I've mentioned before in that real life example, which is, the financiers have their own requirements, and you as a developer and your conveyancing law firm, conveyancer, really needs to know what those terms are before you start agreeing to change any pre-sale.
And just on the pre-sale requirements of most lenders now, what's the sort of approximate percentage they need? Is it 100%? Is it 80% pre-sales, or does it depend on the area?
I think it depends on the lender. Right. I think that pre-sale, there are some non-bank lenders that are prepared to do deals without pre-sales or with low pre-sale levels. Obviously, there might be a cost associated with that. But I think going forward, given particularly like what's happened with Rayland, where all those pre-sale, the deposits were used for, I think that lenders will be even more, interested in scrutinising pre-sale contracts. But I think that depending on the lender, you can get finance without 100% pre-sale cover, but certainly banks would normally want 110%. Or possibly even 120%, but some non-bank lenders will do probably 70, 80%.
Okay, very good. Number 8, what's that one?
Well, with any loan, to a commercial borrower, the finance is not required to make the loan until you satisfy certain conditions precedent. So it's very important that you know what they are, because if there are some that you're just not going to be able to satisfy, you need to know that quickly and have that negotiated out. Otherwise, you're not going to get any money.
Brilliant. Okay. Number 9.
Events of default's another clause. Obviously, you don't want an event of default to occur during the course of your facility, because then you're going to be subject to default interest, which is even higher. The lender could call up the loan. All sorts of nasty things can happen to you. So you should really get an understanding of what they are. And some events of default can actually be triggered by third parties, not the borrower itself. And one of the major ones, certainly in a construction deal, is that the builder goes bust.
Yes.
So obviously, from a lender's point of view, that's a major negative. But instead of immediately creating an event of default, you should negotiate that so that it only is an event of default if you can't find a replacement builder within a certain time frame.
Yeah, brilliant. Okay. And Peter, your final tip?
Well, I suppose it's the obvious one that you really should, in this current market, get advice on the finance documents before rather than after signing a term sheet. And so it's critically important to do so, because the term sheet, especially the indicative or initial ones, contain very little detail, and they won't really help you understand what's coming down the track. So these top 10 tips can be found on my website.
Pass your book over, Peter. I've got to say, this book here, Peter's, we'll just put it back on the main screen. Peter's written a great book that I think is fantastic. There it is, if we can get it so it's not too, there he is there. Really fantastic book, so I'd really encourage you to get a copy.
Thank you very much.
And they can just email you the details as we just put up on the screen there. Is that correct? So yeah, I'll just put it back up again. There we go. So if you want a copy of that book, just go to Peter's website, peterfaludiconsulting.com.au. And
it's available on that site.
And does it cost anything to get that book, Peter?
Pardon?
Does it cost anything?
Yes, there is a cost, but if it's somebody that's referred to me by Rich, then I could waive that.
But even if it costs a few bucks, mate, honestly, the advice that you're giving to your clients is just going to save them potentially hundreds of thousands of dollars.
Yes, I hope so. It has in the past.
It's
and the book has 42 tips, not just 10.
Fantastic. So they're getting extra value. So. Fantastic tips there, Peter. No, they're brilliant. So I'd highly recommend that. Highly recommend that to anyone to do that. So, and as I mentioned before, if anyone there would like to engage our services, we've won, as I said, 33 awards for excellence. We're up for another couple of awards the next month, and we certainly would love to help you. Peter, any concluding comments you'd like to make at this stage? Finish up.
I just think that the whole development and financing of developments is going to change quite dramatically given these building reforms that's going on at the moment. And so people need to be aware of these reforms and how it's going to impact on their business going forward.
Yeah, I just encourage everyone to before you buy your next commercial property or development site or property, whatever, make sure you have a pre-approval in place. Make sure all the conditions of those loans are thoroughly vetted and checked, because as Peter's outlined in today's presentation, you can get yourself into some pretty hot water if you haven't got all of your bases covered. And the devil is in the detail, as many people have found out. And I have to say, Peter is fantastic. He's very high attention to detail. I've got a great business and highly recommend his services.
Thank you very much.
So I think, look, thank you very much for watching the webinar this evening. And thank you, Peter, for sharing your knowledge.
My pleasure. Thank
and
you.
If you'd like to get in touch, my details are there, or peterfaluticonsulting.com.au. And we look forward to bringing you some more information in the future. Thank you and all the best.
There you go. How long did that take?